What's up, party people? It's Private Profits Trading. We're back. Today we're going to go over not having an exit strategy before you enter a trade. So this is another trading rule. This will be number 3. And having an exit strategy is just as important as having a entry. So and everybody's crushing it right now in the markets. It's a great time to be a trader. So I just want to help you guys understand some of the common mistakes that we all made and still make. So, being able to identify those mistakes, we know what we should be able to do to fix them. So that's what this video is here to do, is to help you. So hopefully you stay to the end, you watch all of it. We're going to go through a lesson and we'll have a summary. So let's dive in. All right, so this is a very common mistake that always baffles me. There are so many books, articles, and seminars devoted to the trade setup. In fact, there are many gurus that have made an entire career teaching their unique setup. The trade setup obviously is a very important aspect of a trade, but I argue that the exit is actually much more important than the entry. However, the majority of traders overly concentrate on the entry and treat the exit portion of the trade as an afterthought. They only consider their exit strategy after they initiate a trade. Even worse, most traders treat the exit strategy as a moving target instead of a pre-established target that should be determined even before the trade is entered. And some traders get half the exit strategy correct before they put the trade on. However, this isn't enough, and just as bad as having no exit strategy, these traders feel that by establishing a stop price on the downside of the trade, a sell stop for a long position and a buy stop for a short position, they have an exit strategy. So having a stop price isn't enough. A trader must establish a profit price target on the upside as well. So without an upside price target and downside stop price for every trade, a trader doesn't know his risk reward for that trade before entering. Is it 2 to 1, 4 to 1, 10 to 1? Without knowing the risk reward of a trade before the trade is initiated means the trader is just gambling and not trading. So let's observe the trader. Like many traders, Allen only concentrated on the setup for his trades. And after a while of mediocre trading results, he called to vent his frustration. I'm really getting sick of this. I have great setups and my positions usually start to go my way. However, a lot of times they go against me and I get stopped out. But then the stock comes back and I would have made money if I hung on. I keep playing around with my stop price. First I had it at 25-cent loss for the trade, then I moved it to 40, and now I moved it back to 30. I feel my setups are good, but I keep getting stopped out. So here's the lesson. So Allen, unfortunately, is a very typical trader. He feels he's doing the correct actions by establishing a stop price for the downside, the losing portion of the trade. So when I asked him about his exit strategy on the upside portion of the trade, his response was, it depends on a few factors. I usually try to make 300 per trade, but if I'm having a bad day and need to get profitable for the day, I'll try to make a little more. So let's examine what's wrong with Allen. First, a fixed upside and downside price target should only be used if that strategy has been tested to see if it's profitable. A fixed target is one that is simply placed a certain price away from the entry price and is based on that entry price. For example, let's say a trader has a risk reward goal of 2 to 1 for his trades. If a trader buys a stock at $25 and his objective is to make 50 cents on the trade, sells at $25.50, he would use a sell stop of 25 cents at $24.75. So in Allen's case, he didn't have a fixed price target for his exit. His was based on a dollar amount, which is $300, and he would increase that if he felt he needed to make more money for the day. He didn't have a clearly defined risk to reward profile for the trade before entering. So the lesson, I only recommend having a fixed price target for traders that use analytic software to analyze trades, entries, and exits. I don't recommend fixed targets for traders that use technical analysis for generating their trade ideas. Using technical analysis, a potential trade setup will appear when a certain pattern is realized or an indicator has reached a certain value. So once the setup appears, the trader must analyze the chart and establish a logical price target and price stop for the trade. He then must determine if that trade satisfies his required risk to reward. So for example, let's say a trader is using a chart-based breakout strategy that calls for a buy at $40. So based on the chart, a logical place to put the sell stop would be $39.70, based on that price representing a failed breakout. So on the upside, a logical place for the upside price target is $40.90. This will represent a 3-to-1 risk reward for the trade, and if this is acceptable to the trader, he should put the trade on with those price targets. So in this example, the price targets aren't fixed. Rather, they are generated by looking at a chart and then determining if the risk to reward profile for the trade meets or exceeds the trader's acceptable risk for the trade. So this is very different than seeing a setup and entering your exit targets based on a fixed number. So in summary, all traders must have profit and loss price targets established when a trade is initiated. They should be written down in a trading journal so they can be reviewed. Not having these targets mean you don't know your risk profile of the trade, and that equates to gambling. A well thought out trading strategy will have price targets that can be paper traded using a real-time data demo platform before committing real money to the strategy. So I hope this has helped kind of make you more aware and conscious of keeping a exit strategy in mind before you enter a trade. You know, you want to be able to know where your profit targets are going to be. Profit target 1, profit target 2. What would be my stop? Am I comfortable letting the trade go to 0 if I'm trading options? So you just want to think about your exit strategy. You want to think about how much you're willing to risk for a potential reward. So hopefully this video helps. Any questions, email me, support@privateprofitstrading.com. There'll be some links in the description that you can check out, get some more information. And stay tuned for trading rule number 4. We got 20 of them, so hopefully you get all 20 under your belt and dominate the markets. Happy trading, you guys.